Welcome everybody to the Ellsworth Advisor monthly update for the month of September. Today is October 1st, and I'm Kelly Kuennen and Cameron Miele. Today we're going to talk about basically what transpired in September from a market standpoint, some of the key economic issues that have been happening, what's happened with our portfolios, what's worked, what hasn't worked, and kind of what we see happening over the next month or so. So to start it off, as usual, I'm going to have Cameron talk a little bit about the economy and what's happening.
Thanks, Kelly. A lot of interesting things going on in the economy. I think last month we touched on that we're seeing a slowdown in the manufacturing sector, which is a bit of a concern. But now to compound that concern, we're also starting to see a slowdown in the consumer market. So if you look at the bull market in general, this really since 2009 has been a bull market that's been driven by the U.S. consumer and U.S. consumer spending. In April of this year, U.S. consumer spending was up 0.7%. Every month since April, it's gone down and down and down. Last month, consumer spending increased just 0.1%. And my concern is that the consumer is seeing so much negative news about the global economy. They're hearing about manufacturing slowing down, impeachment talk, China trade, Brexit, all these things that now consumers are starting to actually pull back. And if we see consumers pull back, there could be a self-fulfilling prophecy. Consumers pull back, they're spending less on goods. That means our manufacturers make less. They pull back on their spending. The economy slows down, you go into a recession.
Well, I do want one note on that, and just so it's not misleading to our viewers, but when you say the spending actually isn't contracting, it's just growing at
a slower rate,
okay,
absolutely.
That's important.
Yes.
When it is contracting, then we're really going to be concerned.
Yes.
A little slower growth rate, it's showing a bit of a trend. I think that's the important thing.
That's true.
The trend a little bit is a little, not as robust as they were a couple months ago. It seems to be trending down.
And ironically, while the spending is increasing, but at a slower rate, the consumers actually never looked better. If you look at numbers right now, unemployment rate's holding steady at 3.7%. That's a historically low number. The labor force participation rate edged up last month to 63.2%. Again, a historically high number. Average hourly earnings are now at $28.11 per hour, historically high number. U.S. consumers are holding $9.28 trillion in U.S. depository accounts. The annual inflation rate remains low at 1.7%. That means consumers aren't being priced out of the market. So what this tells me is, again, this is a lot of headline news. It's a lot of fear. It might be irrational. So I still believe that the consumer's strong but scared, and this fear is causing them to pull back. Now, unfortunately, as we've talked about, while the U.S. economy still appears to be quite robust, we're not getting any help globally. There have been a lot of articles over the last several days about both the developed and developing world continuing to struggle, negative rates, devaluation of currencies, and of course all of that money is flowing into the U.S. as a safe haven, which means our rates are going down, the cost of a dollar is going up, which makes it harder for our manufacturers to sell goods overseas. So I think we're still, Kelly, in this Goldilocks economy where the U.S. is strong, globally we're weak. Our consumers are still spending, but they're spending, the growth is less than before.
Right.
But I mean, right now, I still don't see any major issues that cause me a lot of concern.
Yeah, I think the risk of a recession in the short term, meaning the next 3, 6, 9 months, is probably pretty low.
Mm-hmm.
You get further out, who knows? I was at the Delivering Alpha conference a couple of weeks ago in New York, where basically we saw presentations from some of the top investors in the world on the private equity side and in the investment management side. And it was also attended by mostly professional investors. So they were doing various surveys throughout the conference. And one of the big things I took away is that there are good arguments on the bull side of the equation and on the bear side of the equation. So there's not robust bullishness, there's not robust bearishness. The arguments are pretty even, and you look back over the last several months, the market's kind of wallowed around.
Yeah.
A little bit of advancement, but just kind of wallowing around in mediocrity, which really is what I think we're going into a very mediocre stage of the economy.
But yet you look at all that, and we're still at Dow 27,000.
Right. Just kind of.
I mean, we're still kind of almost near. We're only a couple points away from
Right.
all-time highs.
Yeah, we're up from a year ago. We're only up about 3%. You go back to December of 2017. I was just looking at charts on Quad the other day, and from December 2007, before the crash of 08, 09, the market's really only up about 40-some%, like 42, 43%, which over the last 12 years, you're looking at maybe a 4.5% growth rate from a market standpoint pre-crash. So even though valuations seem a little stretched, putting into the context of, hey, the market's way up, well, yeah, it's way up from the lows of March of 09, but I think we're just kind of caught in this churning right now. And big picture, things could be tipped either way. I think you're making a good point with the consumer. The consumer is kind of driving things right now. Manufacturing is going through, definitely a bit of a slowdown at this point. We saw that in 2012. We saw that in, kind of crossed over 15, 16, where we went through a little bit of a manufacturing type recession. We're seeing that slow down right now, but that doesn't necessarily mean it's going to throw us into recession. Where I think the ISM manufacturing number did go sub 50, which indicates contraction. But in an article I read, the reality is, sub 50, okay, yeah, that is contraction, but you need to get even to generally 43 on the ISM, where when you hit that level, then 9 to 12, 18 months later, you end up in a recession. So we're not quite that bad.
Okay, and let's suppose we do get a trade deal with China, and one of the stipulations is they have to buy $1 trillion of U.S. goods over the next 4 years.
Well,
I know.
Yeah, that changes.
Then all of a sudden,
that changes the calculus right there.
Yep.
So we're at a point where there's potential for upside news. There's potential for downside news, but everybody's worried about everything that's out there on the downside already. So it's just a matter of, will one of these things happen? But a lot of people have been planning for it, and nobody's super bullish at this point in time. You look at investor flows into equity funds, actually money's been flowing out of stock funds and stock ETFs for the last 18 months. The flows have actually been negative. And typically for a big rollover in the market, you have everybody's piling in. We're not at that point. Now, if we had a big China trade deal, we had a couple other good economic news come out, things get stronger around the world, could that cause the exuberance? And that would probably be the end all be.
Then that would be the tipping point.
That'd be the tipping point at probably, you'd be looking at probably, S&P probably pushing 4,000 at that point. I think that's kind of run you would get if all of a sudden a lot of good news came up. Then you get the exuberance. That's probably, hey, we're definitely late in the cycle. Things are a little stretch in the economy, which tells me, there's a recession on the horizon, but we don't know how far that horizon's out.
Sure.
From a market standpoint, we've seen volatility, and I'll kind of jump into that in a minute. But in general, I don't see much changing economically over the next couple of months. Now, caveat being, starting about mid-October, we start
get
going
earnings.
to third quarter earnings announcements, which I think it's gonna be a mixed bag. Even early, companies that have announced more recently for second quarter, there's been some surprises on the upside, a little bit more strength on the consumer end. Obviously, there's been some disappointments. The reaction to their share prices has been appropriate based on what they've announced. So the actual individual stocks and pricing on individual stocks has been pretty rational. So that's encouraging. So that kind of helps with what we've been doing with the individual stocks. Going into earnings season, the expectations I think are pretty low going into this season. So, any kind of exceeding of the expectations could definitely give us a little bit of support on the downside. And so you're going to have the headline news driving things until we get into earnings announcements. That's going to be the general tone of where the earnings are going according to expectations is kind of what I'm thinking. Historically, August, September, October are typically the weakest months. August was a weak month. September turned out to be actually a positive month. We're going into October. We'll see what we get. I think everybody's planning for the worst, which means it may not be so bad going into October is kind of the thought process. Put in the context of what happened last month. So the Dow Jones last month, and all this data comes from Morningstar. Last month, the Dow was up 1.95%. Year to date, that takes the Dow to 1708 for the year. S&P 500 last month 1.72, takes it 19.94 year to date. On the international front, year to date, the developed world, measured by the EAFE, up 13.18. Good month last month for developed market stocks, 3.79%. So pretty good showing from international, which has been, relatively weak compared to the U.S. Emerging markets year to date only up 3.65. So emerging markets have definitely struggled with the strong dollar, weakness in Europe, a little bit of weakness in China. So emerging markets has not been that great this year. Last month up 1.8%. So once again, like I said, kind of a good month in September, not a bad month in September. How our portfolios did. Growth of income portfolio last month up 1.4%. So year to date, really looking at positive 12, about 12.05, so right around up 12%. Big performers last month. On the consumer side, Nike was up 11.15%, at least our holdings or our clients experienced 11.15 in Nike. Apple up 7.3. A lot of negative talk around Apple and iPhone expected
Global share of
sales
the
and so
market,
forth. Actually, more recently, the iPhone sales have come in better than expected. So, Apple's still on track. They're having a good year, up 7.3 for the month. Microchip Technologies up 7.62. Back in August, tech stocks got beat up, especially the chip stocks, and so a little bit of bounce from Microchip. Where we saw some pain, Disney down 5% for the month. Disney had a nice run already, so just kind of a give back. I'm not concerned about it. Visa, same thing. Visa is strong, has been strong year to date, but they gave a little bit back last month, down 4.87. And gold, which we've held since the beginning of the year, down 3%. Once again, we've made money in gold, kind of a pullback in areas that have been fairly strong. A little bit of pullback in those three positions. Price potential, which is basically our growth portfolio, 20 growth stocks. For the month, we're actually down 1.8%. I'm sorry, 0.18%. So flat line, slightly negative. We're still up about 22.75 for the year. If you remember, August, we actually were up about 3% when the market was down. So gave back a little bit where we saw strength. U.S. Bancorp about 5.8. Miller Herman, which is actually a furniture manufacturer, they're up 9% for the month. So another consumer play there. Allstate up 6.14. So you're seeing more consumer-oriented stuff working. On the downside, Restaurant Brands, International, QSR, a newer holding of ours, they're down 9.34. So not quite going the way we thought it would, but we have our pulse on, we have a finger on the pulse there. S&P Global down 5.85. Kind of the story where up year to date, still up 18, since our holding period, up 18%. So we gave a little bit back of where it was. Motorola Solutions, another holding of ours that we've had, almost all year, down 5.48%. Year to date, though, we're still up 49% in there. So still Motorola chugging along strong. Everybody's like, Motorola is still around. Well, they don't make cell phones anymore, but they do a lot of other good work around point of sale stuff. So,
but I mean, price potential up 22% year to date.
Yeah. No,
it's nothing to fluff about.
A little bit off, not bad. We'll take it. It's doing what it should be doing. Dividend yield had a good month last month, up 255. So outperformed both indexes, and these are our large defensive dividend-oriented companies. Year to date, 19.19. So that's kind of advancing nice. Where we saw strength, LyondellBasell chemical company up 17% for the month, pretty solid. Prudential up 12.31 for the month, so insurance companies are making some money last month. And then Intel up 8.69, kind of that rebound off, chip stocks getting beat up in August. Our big losers, Waste Management down 3%, still up 31% for the year. Merck down 2%, we're up 12% in there for the year. And then Blackstone gave up 1.85%, still up 69% for the year. So dividend yield, solid month for dividend yield, no issues there. Small caps, small caps have gotten, with the market volatility, the headline news, small caps have gotten beaten up a little bit. For the month, our small cap portfolio was down 3.2%, still up about 14% for the year. So, we've seen some pullback in small caps. They were, obviously they've been stronger. Some of the winners there, LifeVantage up 12.66%, Ameresco up 11.6%. Orthopediatrics up 9.54%. So nice gains there. Typically we have one or two stocks that are up more than that, but those are our big gainers in that portfolio. Our big losers, Bandwidth, down 25% for the month, but we're still up 59% in our holdings. So once again, they had a big run. We gave some back there. Novacure, that gave it back about just under 18%, 17.7%. But once again, for the year, our holdings in there were up 123%. So not so bad. It's worked out for us just fine. Tandem Diabetes, kind of the same situation, down 18% for the month, but we're still up 34% in that holding. So once again, the small cap stocks are all over the board. Typically, we have a couple big gainers, nice teams, but nothing crazy. We had some losers, lost 3% there. But in general, we've seen a little bit of strength just today in the rollover of the month. We've seen some strength in the small caps. Rates are, it seems like rates are going up a little bit. That seems to be when small caps have worked a little bit better for us. So, in general,
by and large, I mean, you have to be very happy with where the portfolio's at.
Yeah, I think, I'm fine with it. I think in general, compared to other small cap mutual funds, ETFs, I like where we're positioned. Definitely selective. It's doing what it should be doing. It's always gonna be more volatile. So, from a big picture standpoint, I think our quality bent has been working. Our quality slant's been working for us. In the short term, you have to expect volatility in October, especially as we get into earnings season. That'll run mid-October into mid-November. That'll really give us a good feel of what's happening. By the time we're sitting down here early November, that's really going to give us the landscape of what's really happening with earnings. This manufacturing slowdown. We'll be able to get a little bit more color on that. How slow is it? One report today, I think Paychex, they do one of their surveys they do, and what they were saying is basically there was an uptick in small business from a hiring standpoint. Small business.
That's great. Small business is the lifeblood of the economy.
Exactly. So that's actually on the upswing. That's positive. Good consumer sentiment. I think that kind of drives us through, and it's really getting through the headline news, which we haven't heard much the last several days on trade, so that's been a little quiet. A lot of talks on impeachment.
I was going to say, anything going on in Washington, D.C.?
Impeachment, I've read several articles over the last several days. You look back, Nixon, Clinton, those are the most recent impeachments. That doesn't do anything to the economy or the market, except for headline news, so whatever happens. I'm not too worried
think about the portfolio, what we've talked about. You've got a U.S. focus.
Yep.
Small exposure international, high quality companies, and then you have plenty of liquidity so you can take advantage of market movements.
That's the thought process right now.
It seems pretty simple, but
we're keeping
it's working.
Simple. Bottom line, know the companies we're in, keep it simple, and that kind of gets us through the last part of this phase of the cycle, which could go on for a while, and we need to participate if it does drag on. But then again, if things turn, I think our damage is going to be minimal on the downside or manageable, I think is the right way to put it.
And with plenty of liquidity, as soon as you see that turn, you're right back in the market and you're beating on the upside.
That's the thoughts. So that's kind of where we're at today. If anybody has any questions or want to dig in a little deeper with your accounts, please give us a call. If not, enjoy the next month of beautiful weather before things get ugly in November. Hopefully we're wrong on that one. Thanks again, and have a great day.
Thank you, everybody.